Hey guys, hope you guys survived yesterday's volatility event. This was nuts, man. I don't remember the market ever nuking like that before. Even when we were getting flash crashes every month in 2021, 2022, they were like max 8 to 10% flashes, right? And they would get bought up immediately. So it was like every major flash was just a liquidation event so that people could take stops and then run it back. This one was probably one of the deepest, well, it was the deepest I've seen since last cycle. So hopefully you guys are protected. If you got damaged on this one, trust me, you're not alone. Some of the best traders I know got hit on this one. I got smoked last night for sure. Like I had a couple of limit bids and they just ran right through them into the stops. So these happen, right? It's like part of trading. You just got to accept it. There's going to be days like that and you bounce back. So don't let it affect you. Don't let it get to your head. You know, if you've done it before, you'll do it again. If you've lost money, you'll make it back. Just stay resilient, go to the gym, think about other shit, and then get back to it when you're ready. In the meantime, just a little side note, I've been tracking the VIX volatility index, which tracks volatility events for equities indices. And I've been tracking this on the monthly going way back. And every major volatility event had some form of a real estate catalyst or a country where their bond market just broke or whatever. But the point is, when the volatility event happens, you get this exponential spike in the VIX, and they typically will base off of these two levels here. So I'm looking at the monthly chart, and you could see between 11.6 and 10.4, you get this bottoming structure. And again, it's weird to do TA on the volatility index, or they even have the VVIX, which is the volatility of the VIX. I mean, they have a whole bunch of these, BVOL, so Bitcoin Volatility Index. There's a whole bunch of them, but the point is they all respect TA in some way. And this just happens to be a very reactive zone. All the major spikes come off that zone when it's ready. This one just happened really fast. There was no warning. Again, there was black swan catalyst in the air. We kind of know there's war looming. Bond markets are breaking. 10-year yield is just completely going through the ground. So there is warnings, but I mean, if you just look at the months that led to the volatility event here, or the one that happened from here, there was a ton of basing in these in this box right here, and this one just tap, and then ripped up. The only two things to take away from this really is this was COVID low. So basically the March 20 low where all crypto got blown out. You could buy ETH for $80 and there was a ton of shit coins that were basically at zero. So you could have just like swept the floor with all these vaporwares, and then whichever one survived, eventually you would do 100x basically. So there was some massive volatility going into it. This is the monthly chart, but if you go into the weekly, when the COVID black swan hit, you could see that first bar that gapped up over here on the weekly hit the 49, basically 50% or 50 point volatility, and then eventually went all the way to 85, which was the absolute highest in our lifetime. So I mean, if you go back further, okay, maybe 09, so the real estate crash was their subprime real estate market crash was higher. But you know, if this is your first or second cycle or even third, this is the first time you really experienced a major volatility event with crypto. The max was 85 and it started at 45 yesterday. Going into today, we basically capped out at 65. So entering that max volatility zone, here we had 45, yesterday we had 65. So it was more of a volatility event than the COVID lows. And again, it doesn't mean it has to go up to 85. It just means that we've breached a level on the chart that suggests we're entering max volatility, which is basically above these ticks over here, or you could say above the mean threshold, which is, or the mean of this monthly chart or weekly, which is down here at like 28. So again, we had forever suppressed dealer hedging on the way down, which is what kept the volatility low. But when you get that black swan event, obviously there's going to be a major spike. The good news is it happened. We hit that COVID week, high on the VIX, and then it pulled back. And it looks like we're basing, again, it's a little bit higher, but at least it's kind of calmed down here. Now we got to watch how the market reacts for the next few weeks. This could be a major deleveraging event, especially if there's some war games, war news going on. You could expect that dealers and hedge funds and anyone involved in equities, they're going to be de-risking quite a bit. And the thing with this is it's dominoes, right? You get a few big whales that are de-risking, and that's going to trigger stops for other people, and then people are just going to start panicking, and that's when you get capitulation. So I'm not saying it's going to happen, but again, this was a major volatility event. So hopefully you guys are good, and maybe you picked up some good spot positions last night. It's definitely, everything's on discount after the highs we were at recently. So hopefully you got some good deals. We're going to look at Sol. So looking at Sol, we're trying to identify where the next entry could be. This is the weekly chart. They basically took these highs and then started to consolidate, took this internal high, and then completely collapsed from there. If we look at the reactive zone, sometimes it's a little bit harder to see on the candlestick chart. So what I'll do is push it into the line, and you can see the pivots. On line chart, we're only using the candle closes, not the wicks, right? So intraday volatility is drowned out by the final candle close. And then you could see between this bottom right here and this inversion right here, we could start building a case for this being a reactive zone. You could see when we broke through it, we retested it and we got a bit of a bounce. Here we're trying to consolidate. Here we're breaking down below it. So this is just to kind of frame on the high time frame where we are. We're below a reactive zone. So you want to see what the retest of the top of the reactive zone is once we pull back into here. Even if we wick into this weekly imbalance just to rebalance this inefficient move, you want to see whether we start consolidating and building above the reactive zone, or do we just wick into here to rebalance and then start closing and building below it. That's usually going to be a good indicator for where the market is going to move next. So that's your reactive zone. And now we'll look at the range. The range is all-time high at 260. If you look down here, we have a major 3-month imbalance, because that was a very inefficient move on the way up. It shows the disproportionate amount of buying that was going on down here at the lows, and as this green candle was building. So that's something to be aware of. This can draw down all the way to $31 on the quarterly chart. On the weekly, you could see there's a bit of this one down candle in a fleet of up candles is going to be a weekly order block. It looks like they stopped the volume right above it. Or sorry, they tapped the weekly. They didn't get to the 3-day, but they tapped the weekly and bounced off of it. You could see they swept all this internal range and then bounced. So this was one of the setups I was looking at originally. It just happened, with a blink of an eye last night. It was crazy. So I mean, it's hard to be ready for those volatility events. But I mean, if you had bids down here, holy shit, you made good money last night. If you zoom out to the 3-day, here's your 3-day order block resting right above the range point of control. So all the volume is in this pocket right here. And again, you can see there's a cluster that developed here before taking off. So this is usually going to be a good area for demand, and you have a 3-day order block where they stop the volume right above it. So I'd imagine if they did come down again, they would probably catch bids here at the 108 mark all the way down to 98, especially based on volume. Now, if you go into intraday, last night with the bottom, you could see equal lows were formed over here. So right here, you got equal lows. That could easily get swept again into the 3-day order block. So that's something I'm watching. We'll go over the trade setup, but I just want to clear up the range real quick. This range, by the way, was part of a market maker model that I was tracking. I don't know where I posted it, but somewhere up here I was posting it. I can't remember which Discord or whether it was on X, but you can see a very clear buy side of the curve and then sell side targeting this liquidity arc right into these lows. So that was a good area to bid. We'll see if it follows through. My bias is still going to be down, and this could just be a mean reversion pop after such a drop, right? So what I'm looking for effectively is within the range, that 3-day order block that we identified, supported by volume, should help price base somewhere over here. It could be baiting people as well. You know, there's a lot of people that trade order blocks, and I'm sure market makers know that people are going to be accumulating their stops below the order blocks. So there's a chance that they drop it again, taking the intraday lows here into this demand block, and then just bounce around, sweeping it again into the point of control and slightly below. So the way I've structured the trade, it's a little bit crazy, but it's basically going to be a 7-bid trade for me with a 27% wide stop. The idea is with every entry, I'm basically scaling up my size. So let's say I'm taking the entry in 7 parts, 1, 2, 3, 4, 5, 6, 7, with about a 6 to 7% stop at the bottom entry. Then I'm dividing it up, but let's say I have like 3 soul entry here. Here I have 5, here I have 8, here I have 15, here I have 20, here I have 50, and here I have 100. The point is, as you go down, the size is increasing, bringing down your average entry to something like that. So instead of entering right up here with a 27% stop, what you're doing is you're taking a blended average entry as price is coming down. I don't recommend doing it, but if you have it like, if your size ascends as the price descends, then it can be a strategy, right? Especially when the market is this volatile and you're getting like 20-40% nukes on majors, right? So it's a wide stop, but the idea is my average entry is going to be around, when it's all said and done, it's going to be like 92 or whatever it is, based on the way I've sized the trade. And it's clustered mainly around that 3-day demand and volume. So it should be a pretty safe area. And again, that could be my final words, but point is, I'm not buying the breakout, or I'm not buying the top of a green candle. I'm waiting for it to pull back into an area of interest that should get supported by most big players, right? Now, if this works out and I get the entry, what are the targets? So let's map that out. So I'm using the 1-hour chart for this. All the way down, these are all failed swings. Each wick failed to take out the previous liquidity point. So there's a really strong liquidity arc, and when it does reverse, that final move is going to be very aggressive, because as price is ascending, these liquidity pockets are either going to be forced to close, or they're going to get stopped out or liquidated, adding fuel to the fire. So as people are market buying and chasing price up, those stops are going to become forced buyers above these wicks, adding to the buy pressure, and it's just going to keep melting up. I like it when it's this when it looks like this, as opposed to, let's say, after this right here, it went up and grabbed those stops and continued down. Then it consolidated and then it grabbed them and then went down. When it does that, it's a very measured move down, and they're taking liquidity as price progresses. It's not as clean. When it's like this, it's kind of leaving a footprint for you on where you could long this to. So I'm basically looking at TP1 here at this liquidity pool. It doesn't have to be at the external high within this pool. I would rather do it just above these two or even slightly below, but I've just used for explanation purpose, I'm using this level. TP2 basically below these highs, but above these. I feel like if these get triggered, you might get a nice push into this imbalance. And then TP3 is going to be the equal highs. So I look at these two as relatively equal highs because they're within 3% of each other, 2.8. So I like that as a final TP. And then again, if they break out above 210, you're looking at the weekly external high. So it would make sense to have a runner in case it reprices from here to here, another 23%. So that's the trade setup. The bear scenario is that demand gets completely filled and the supply just keeps coming in. Those would be people that bought at 20, big funds or companies that bought, or whales that bought at 20 and 14, and they're basically still up 5-6x. So for them to just keep dumping supply, knowing that they bought the Pico bottoms, it really doesn't matter where they're going to sell. So if that sell pressure keeps happening after filling this demand zone, then yeah, that's pretty much your invalidation. And then, you're basically wrong, I'm wrong, and we chalk it up as a loss and on to the next trade. No emotion. But yeah, that's Sol. Hopefully the volatility index stabilizes and we just get a move down to fill our entries, but this is definitely going to be a trade that I've set limit orders for this, and maybe I don't get filled all 7, but the idea would be if it only dips into here and my larger bids don't fill, I wouldn't be scared to add as it goes green. So like this, I'll just start adding on structure on the way up. Shouldn't let that stop you. If anything, it just confirms that it's basing in the area of interest, and you can then just keep adding, because you're not adding up here, you're adding still down here. All right, guys, enjoy your night. Hopefully you guys got some deals. Catch you on the next video.